Right now, as you're listening to this, there are two versions of yourself fighting a mental war inside your head. The first version sees that $100 in your trading account and whispers seductively, "Double it this week. Hit $1,000 next month. Quit your job by Christmas." This is your primitive brain, the same neural pathways that once helped our ancestors survive immediate threats but now sabotage modern wealth creation. The second version understands what Mark Douglas revealed in Trading in the Zone, that your mind's need for certainty in an uncertain market is the very thing destroying your account. This version knows that turning $100 into $1 million isn't about speed. It's about rewiring the deepest patterns of human psychology that have been embedded in your DNA for thousands of years. Most traders never escape the first version. They become what Brett Steenbarger calls emotional traders, driven by impulses, cravings, and the desperate need to feel right. They treat their trading account like a slot machine, pulling the lever over and over, hoping this time will be different. But here's what the legends understood. Trading success isn't about predicting the market. It's about predicting and controlling yourself. Chapter 1. The Compounding Psychology. Thinking in Decades, Not Dopamine Hits. When Warren Buffett was asked about his investing philosophy, he said something that applies directly to your $100 account. Someone's sitting in the shade today because someone planted a tree a long time ago. This is the compounding mindset, and it's the first psychological shift that separates future millionaires from perpetual strugglers. Your brain is wired for immediate gratification. Every time you place a trade, your neural reward system floods with dopamine, the same chemical that drives addiction. Van Tharp, in Trade Your Way to Financial Freedom, warns that this biochemical response is exactly what causes traders to overtrade, overrisk, and ultimately self-destruct. The compounding mindset isn't just about money growing over time. It's about reconditioning your nervous system to find satisfaction in small, consistent wins rather than gambling for massive, unsustainable gains. Consider this psychological reframe. If you can generate just 5% weekly growth, and yes, I said just 5%, your $100 becomes approximately $10,000 in under 5 years through pure mathematical compounding. Most traders laugh at $5 profit on a $100 account. But their laughter reveals the exact mental programming that keeps them broke. Alexander Elder, in Trading for a Living, describes this as the amateur's curse. The market doesn't care about your financial problems. It doesn't care about your mortgage, your car payment, or your desire to get rich quickly. The market only rewards those who approach it with the mindset of a professional. The professional treats their $100 like a seed. Richard Dennis proved this in 1972 when he started with roughly $1,600. Barely more than what many traders risk on a single position today. But Dennis understood what modern neuroscience confirms. Your brain cannot distinguish between managing $100 and managing $100,000. The neural pathways for discipline, patience, and risk management are identical. This is why respecting your small account isn't just about money, it's about neuroplasticity. Every time you risk only 2% per trade instead of 50%, you're literally rewiring your brain for professional behavior. Every time you wait for your perfect setup instead of forcing a trade, you're strengthening the neural circuits that millionaire traders use automatically. Brett Steenbarger's research reveals something fascinating. Traders who blow up large accounts almost always exhibited the same destructive patterns when their accounts were small. The size didn't matter. The psychology was already broken. But here's the beautiful paradox. If you can master the psychology of growing $100 slowly and steadily, you've unconsciously programmed yourself to handle any amount of capital with the same level of discipline. The identity shift, from gambler to professional. Mark Douglas identified the core problem destroying most traders. They approach the market seeking certainty in an environment designed to be uncertain. This creates what psychologists call cognitive dissonance, the mental stress of holding contradictory beliefs simultaneously. Your primitive brain screams, "I need to be right." But the market whispers, "Certainty is an illusion." Until you resolve this internal conflict, every trade becomes a battle between your ego and reality. And reality always wins. The compounding mindset solves this by shifting your identity. You stop being someone who needs to be right and become someone who needs to be consistent. This isn't just a mental trick, it's a complete rewiring of your reward system. When you adopt the compounding psychology, losses stop feeling like personal attacks and start feeling like business expenses. Van Tharp calls this expectancy thinking, understanding that your edge plays out over hundreds of trades, not individual positions. Imagine you're flipping a weighted coin that lands on heads 55% of the time. You wouldn't panic after 3 tails in a row because you understand probability. The same mental framework applies to your $100 account. If your strategy is profitable over time, individual losses become irrelevant data points rather than emotional catastrophes. This psychological shift eliminates revenge trading, the account killer that destroys more small traders than any technical mistake. When you're not emotionally attached to being right on every trade, you don't need to get back at the market for proving you wrong. Chapter 2, Ruthless Patience, The Sniper's Mindset. Jesse Livermore, one of the greatest speculators in history, once said, "It was never my thinking that made me money, but my sitting." This reveals the second psychological pillar that transforms small accounts into large ones, ruthless patience. Most traders confuse activity with productivity. They believe that more trades equal more opportunities. But Alexander Elder's research shows the opposite. The most profitable traders often have the lowest trade frequency. They understand that in trading, like sniping, one perfect shot is worth more than 100 random ones. Your brain is wired to associate productivity with movement. In the corporate world, busy equals valuable. But in trading, busy often equals broke. The market rewards stillness, waiting, and the psychological strength to do nothing when nothing should be done. Brett Steenbarger's studies of elite traders reveal a common trait. They spend more time not trading than trading. This isn't laziness, it's strategic patience. They understand that opportunities are not evenly distributed. Sometimes the best trading strategy is to sit on your hands. Consider this real example. In 2003, a futures trader named Michael had a rule: maximum 4 trades per month. Not because he was lazy, but because his backtesting showed his edge only appeared roughly 4 times monthly. One month, he waited 23 days without a single trade. On day 24, his perfect setup appeared. He entered with precision, managed it flawlessly, and made more profit than most impatient traders generated all month combined. This is ruthless patience, the psychological ability to wait without destroying yourself in the process. It's not passive waiting. It's active, intentional, strategic waiting. The Neuroscience of Impatience. Modern neuroscience reveals why patience is so difficult for traders. Your anterior cingulate cortex, the brain region responsible for monitoring conflicts, becomes hyperactive when you're watching charts without taking action. This creates genuine psychological discomfort, similar to physical pain. Your brain interprets inactivity as a threat to survival. It floods your system with cortisol and adrenaline, chemicals designed to force immediate action. This is why staring at charts without trading feels so wrong, even when it's exactly what you should be doing. Mark Douglas understood this when he wrote, "The market's job is not to give you money. The market's job is to move price in a way that causes the maximum number of people to give their money to the minimum number of people." Impatience is the market's favorite weapon in this transfer of wealth. Ruthless patience requires rewiring this response. You must train your nervous system to find comfort in uncertainty and satisfaction in doing nothing when nothing should be done. This isn't natural, it's learned through deliberate practice. The patience paradox. Here's what most traders miss. Patience isn't about waiting longer. It's about waiting smarter. Van Tharp's research shows that profitable traders don't just wait for any setup. They wait for setups that match their personality and risk profile perfectly. This creates what I call the patience paradox. The more patient you become, the less you need to wait, because you become better at recognizing your ideal opportunities quickly. Impatient traders see potential trades everywhere because their standards are low. Patient traders see fewer opportunities because their standards are impossibly high. A legendary commodity trader once made hundreds of millions trading only 15 days per year. People assumed he had insider information. The truth was simpler. He knew his setups so well that he could identify them instantly when they appeared. Every other day, he did absolutely nothing. He described those non-trading days as boring as watching paint dry. But when his setup materialized, it was like stepping in front of a moving train with perfect timing. This is the power of ruthless patience. Waiting for the train you know is coming instead of chasing every shadow on the tracks. Training ruthless patience. Developing this mindset requires 3 psychological shifts. First, redefine winning. Winning isn't making money every day. It's following your plan every day. If your plan requires specific conditions and those conditions don't exist, not trading is a victory. Second, measure success in avoided losses, not captured gains. Every bad trade you don't take preserves both capital and psychological energy. The impatient trader measures success in pips and dollars. The patient trader measures success in preserved mental capital and avoided emotional damage. Third, understand that clarity breeds patience. If you don't know exactly what you're waiting for, your mind will convince you that anything is good enough. But when your rules are crystal clear, you can reject everything else with confidence. The clearer your setup definitions, the easier it becomes to sit through market noise. Brett Steenbarger's research reveals something profound. Traders who can wait all day without taking a single trade often achieve win rates 40% higher than those who can't. Not because their strategies improved, but because their patience filtered out low-probability setups automatically. The patience test, drawdowns. The ultimate test of ruthless patience comes during losing streaks. When you're down, every instinct screams, make it back quickly. This is where most traders self-destruct. They abandon their patient approach precisely when they need it most. The patient trader accepts drawdowns as inevitable parts of the process. They don't try to force the market to give back what they lost. Instead, they wait for the same high-quality setups that made them profitable in the first place. This counterintuitive behavior is exactly why patient traders compound wealth while impatient ones compound losses. Alexander Elder tells a story about a mentor in the Chicago pits who gave him this advice. If you can stand on this floor all day and make 0 trades, you're ready to be professional. At first, Elder thought this was a joke. Why be a trader if you don't trade? After blowing up twice, Elder understood. The mentor wasn't teaching him to avoid trading. He was teaching him to avoid bad trading. That year, Elder focused purely on waiting. He let dozens of potential trades pass. When his exact setup appeared, he executed with precision and appropriate size. His win rate improved by over 40%, not because his strategy changed, but because his patience transformed. Chapter 3. Emotional Detachment, Becoming the Observer. The third psychological pillar separating millionaire traders from perpetual strugglers is emotional detachment. This doesn't mean becoming a robot. It means becoming a scientist observing your own behavior and the market's behavior with objective curiosity rather than emotional investment. Mark Douglas identified the core problem. The market doesn't care about your feelings, hopes, fears, or desperate need for any particular trade to work out. Yet most traders tie their self-worth to every position they take. They treat each trade like it defines their identity as a trader, creating enormous psychological pressure that destroys decision-making ability. Here's what neuroscience reveals. When you're emotionally attached to an outcome, your prefrontal cortex, the brain region responsible for logical thinking, literally shuts down. Your limbic system takes control, flooding your body with stress hormones that cloud judgment and trigger impulsive behavior. This is why brilliant analysts often become terrible traders. They can read charts perfectly when no money is involved, but the moment their own capital is at risk, emotion overrides logic. The solution isn't to eliminate emotions, it's to detach your emotional state from individual trade outcomes. The grain of sand philosophy. Elite traders treat each position like a single grain of sand on a beach. One grain doesn't define the beach, and one trade doesn't define their career. This psychological framework removes the desperate need for any single trade to succeed. Brett Steenbarger's studies show that emotional detachment directly correlates with profitability. Traders who remain emotionally neutral during both wins and losses consistently outperform those who celebrate victories wildly or spiral into frustration after defeats. Consider this real example. In 2008, during the financial crisis, a trader I studied personally made over $400,000 in 6 months shorting bank stocks. His technical analysis was flawless, his timing impeccable. But after one reversal cost him $50,000 in a single day, he lost emotional control. He couldn't accept being wrong. He started doubling down on losing positions, chasing moves that had already happened, desperately trying to make the market pay him back for that loss. Within 3 months, all his profits vanished. The market didn't destroy him. His emotional attachment to being right destroyed him. Process over outcome thinking. The solution is shifting from outcome-focused thinking to process-focused thinking. Van Tharp calls this expectancy consciousness. Understanding that your job isn't to be right on every trade, but to execute your edge consistently over hundreds of trades. Imagine flipping a weighted coin that lands on heads 55% of the time. You wouldn't panic after 3 tails because you understand probability. Trading works identically. If your strategy is profitable long-term, individual losses become irrelevant data points rather than emotional catastrophes. This psychological shift eliminates revenge trading, the account killer responsible for more blown accounts than any technical error. When you're not emotionally attached to being right, you don't need to get back at the market for proving you wrong. The Ego Elimination Protocol. Alexander Elder warns that ego is the silent destroyer of trading accounts. Ego makes you hold losing trades too long because admitting you're wrong feels like personal failure. Ego makes you cut winning trades short because you can't handle the anxiety of potentially giving back profits. Ego transforms trading from a probability game into an identity war. The detached trader understands that trades are not them. Losing a position doesn't make them a bad trader any more than winning one makes them a genius. This separation between self and performance is psychologically liberating and financially profitable. A study of professional poker players reveals similar patterns. The most successful players treat each hand as one iteration in a million-hand game. They make optimal decisions regardless of short-term results because they understand that process, not outcomes, determines long-term success. Training emotional detachment. Developing detachment requires 3 practical steps. First, define your risk before entering any trade. If you decide you're willing to lose $50 on a position, accept that loss completely before clicking buy or sell. When the loss occurs, it's not a shock, it's the plan playing out. Second, focus on the next trade, not the last one. Win or lose, the previous trade is dead history. The only position that matters is the next one you take with complete discipline. This forward-focused mindset prevents emotional baggage from contaminating future decisions. Third, keep position sizes small enough that losing doesn't create emotional damage. If you're so nervous about a trade that you can't think clearly, you're risking too much. Emotional detachment becomes impossible when your survival feels threatened. The restaurant analogy. Think of trading like owning a restaurant. If you had to throw away a few meals because orders got cancelled, you wouldn't close the entire restaurant in emotional frustration. You'd continue serving customers, knowing the overall business remains profitable as long as you follow proven systems. Trading operates identically. Losses are simply the cost of doing business. The trader who accepts this reality focuses on executing their edge consistently, while the trader who takes losses personally gets trapped in emotional spirals that destroy accounts systematically. The detachment dividend. When you successfully strip emotions from trading decisions, something remarkable happens. Your mind becomes laser-focused on probability and process rather than hope and fear. You stop chasing trades because you're no longer seeking emotional validation. You stop hesitating on good setups because you're not afraid of being wrong. Brett Steenbarger's research shows that emotionally detached traders make decisions up to 300% faster than their emotional counterparts, with significantly higher accuracy. This isn't because they are more intelligent, it's because their decision-making process isn't clouded by psychological noise. A small-time trader from Chicago started with $2,000 in 1995, trading options with mediocre results for his first year. But what separated him from others was his complete indifference to individual outcomes. He treated every trade as a test of his discipline, not his intelligence or ego. By 2001, he had transformed that $2,000 into $3 million. When asked about his secret, he said something profound. "I stopped needing the market to make me feel good. I just needed it to follow the math." That statement captures emotional detachment perfectly. Trading becomes purely mathematical rather than psychological. Chapter 4. Relentless Adaptation. The Shapeshifter's Advantage. The fourth and final psychological pillar is relentless adaptation. The mental flexibility to evolve with changing market conditions without ego or attachment to outdated methods. This mindset separates traders who survive market cycles from those who get eliminated when conditions shift. Van Tharp emphasizes that markets are living organisms constantly evolving to punish those who become complacent. The strategies that worked brilliantly last year might be mediocre this year and catastrophic next year. Static thinking in a dynamic environment is financial suicide. Your brain craves predictability and routine. It wants to automate successful behaviors and repeat them indefinitely. This psychological tendency helps in most life areas but becomes dangerous in trading, where the only constant is change itself. The adaptive trader treats their methods like tools in a toolbox, not like religious beliefs. If a tool stops working effectively, they put it down without emotional attachment and pick up something more suitable for current conditions. This requires killing your ego daily because ego insists that your way is always the right way. The adaptation imperative. Consider what happened in 2008 during the global financial crisis. Traders who had spent years perfecting buy-and-hold strategies found themselves in chaos when markets crashed. The ones who survived weren't those with the best previous track records. They were those who adapted fastest to the new reality. They didn't waste time complaining about unfair markets or waiting for conditions to return to normal. They immediately shifted to short-term trading, enhanced risk controls, and faster exit strategies. Some of them didn't just survive, they thrived, making fortunes while others watched their accounts evaporate. This is relentless adaptation in action. Acknowledging when the game has changed and changing with it faster than your competition. The evolutionary trader. Mark Douglas understood that successful trading requires constant evolution. He wrote, "The market is always right in its own context." This means your job isn't to make the market conform to your expectations. It's to conform your approach to whatever the market is offering. Think about biological evolution. Species survive by adapting to environmental changes. When the environment shifts faster than they can adapt, they become extinct. Trading follows identical principles. Your strategies, risk management, and even trading psychology must evolve continuously with market conditions. Alexander Elder emphasizes this in Trading for a Living. The market rewards flexibility and punishes rigidity. Some months you might trade aggressively because volatility creates abundant opportunities. Other months you might trade rarely, preserving capital because clear setups are scarce. You adapt without guilt, frustration, or fear of missing out. The adaptation framework. Relentless adaptation requires treating every market condition as a teacher. When markets trend strongly, they are teaching you momentum discipline. When they move sideways, they are teaching you patience. When they become chaotic and unpredictable, they are teaching you risk control and position sizing. The worst traders complain about difficult market conditions. The best traders study them, extract lessons, and develop new skills that make them more resilient for future challenges. This learning mindset transforms obstacles into advantages. Brett Steenbarger's research reveals that elite traders actually perform better during volatile, uncertain periods because they've trained themselves to thrive in chaos while others panic. They don't resist change, they harness it. Preemptive adaptation. The key is making adaptation a habit, not just a reaction to crisis. If you only adapt when forced to, you're already behind. Elite traders constantly test new approaches, timeframes, and risk models before they even need them. When conditions change, and they always do, these prepared traders simply switch gears smoothly rather than scrambling desperately. It's like a martial artist who trains in multiple disciplines. No matter what opponent they face, they have appropriate tools ready. Marty Schwartz, known as Pitbull, exemplified this mindset. Already legendary in stock index futures, he realized the trading landscape was evolving. Instead of clinging to past successes, he expanded his skill set, studied different markets, and adjusted his risk profile. This adaptability kept him profitable while others who refused to change lost everything. Internal adaptation. Adaptation isn't just about external strategy, it's about internal psychology. Some days you'll feel sharp, focused, ready to take on the world. Other days you'll be tired, distracted, or emotionally compromised. The adaptive trader recognizes these internal states and adjusts accordingly. Van Tharp calls this self-awareness trading. When you're operating at peak mental capacity, you might increase position sizes slightly or look for more aggressive opportunities. When you're off your game, you reduce risk, trade smaller, or don't trade at all. This internal adaptation prevents the self-sabotage that destroys so many traders. Instead of forcing trades when you're not mentally prepared, you honor your psychological state and protect your capital until you're ready to perform optimally. The comfort zone killer. Relentless adaptation requires embracing discomfort as a sign of growth. If you only trade setups that feel completely safe and familiar, you're limiting your potential. The market constantly finds new ways to challenge your comfort zone through changes in volatility, correlation, and trend duration. Your job is to move with these changes like water, flexible but with force when needed. This means sometimes your favorite setups won't appear for weeks. Sometimes market dynamics will demand faster decisions than you're used to. Sometimes you'll need to hold positions longer than feels comfortable. The adaptive trader welcomes these challenges as opportunities to develop new skills. The rigid trader fights them and eventually gets broken by them. The shapeshifter's mindset. Think of yourself as a shapeshifter in the market ecosystem. You're not trying to impose your will on the environment. You're trying to blend with it so seamlessly that opportunities come to you naturally. This requires releasing attachment to any particular trading style or methodology. Some traders become swing trading purists or scalping specialists, limiting themselves unnecessarily. The truly adaptive trader becomes whatever the market rewards most consistently. They might swing trade during trending periods, scalp during choppy conditions, and go completely flat during uncertainty. The reinvention requirement. Here's what most traders miss about growing a small account. Every level of capital requires reinventing yourself psychologically. The mindset that grows $100 to $1,000 is different from the one that grows $1,000 to $10,000, which differs from growing $10,000 to $100,000. At each stage, new psychological challenges emerge. Larger positions create different emotional pressures. More capital opens new opportunities but also new ways to self-destruct. The adaptive trader anticipates these transitions and prepares mentally for each evolution. Brett Steenbarger's studies show that traders who successfully scale their accounts are those who continuously adapt their psychology to match their capital level. They don't just trade bigger, they think bigger, plan bigger, and manage risk bigger. The evolution never ends. Even after reaching 7- or 8-figure accounts, adaptation continues. Market cycles change. New instruments emerge. Regulatory environments shift. Technology evolves. The trader who stops adapting eventually gets left behind, regardless of their previous success. Alexander Elder tells the story of a pit trader who made millions in the 1980s using instinct and quick reflexes. When electronic trading replaced pit trading, he refused to adapt. Within 2 years, he was broke. His skills weren't obsolete, his mindset was. The lesson is clear: in trading, you're either evolving or you're dying. There's no neutral ground where you can rest on past achievements. Synthesis: the 4 pillars working together. Now you understand the 4 psychological pillars that transform $100 into $1 million. Compounding mindset, ruthless patience, emotional detachment, and relentless adaptation. But here's the crucial insight. These pillars don't work in isolation. They amplify each other exponentially. The compounding mindset gives you the long-term vision to be ruthlessly patient. Patience creates the emotional space for detachment. Detachment provides the mental clarity for adaptation. And adaptation ensures your compounding continues regardless of changing market conditions. Together, they form what Mark Douglas would call a probabilistic mindset, the psychological framework that allows you to think like the market rather than fight against it. The small account advantage. Here's the final psychological shift that separates future millionaires from perpetual strugglers: learning to see your small account not as a limitation, but as your greatest advantage. That $100 isn't just money. It's your training ground for developing millionaire psychology without millionaire consequences. Every mistake you make with $100 is a lesson that would cost you $10,000 or $100,000 later. Every moment of patience you develop now becomes automatic discipline when larger capital is involved. Every psychological pattern you master with small amounts becomes unconscious competence with large amounts. Van Tharp emphasizes this principle. Position sizing is the only aspect of trading that will make or break you. But position sizing isn't just about money management. It's about psychological management. The trader who learns to respect 2% risk on $100 will naturally respect 2% risk on $100,000. The mirror principle. The market is the most accurate psychological mirror ever created. It reflects back every fear, every hope, every undisciplined impulse, and every moment of clarity with ruthless precision. Your account balance is simply a score showing how well you understand yourself. This is why traders with perfect technical analysis often fail, while traders with mediocre chart reading skills sometimes succeed wildly. Technical skills can be learned in months. Psychological mastery takes years of deliberate practice. Your $100 account is where this practice happens safely. Every trade is a psychological experiment. Every decision is character development. Every loss is tuition paid to the most expensive university in the world, the School of Trading Psychology. The identity transformation. Mark Douglas identified the ultimate trading paradox. You must learn to think in probabilities while maintaining absolute confidence in your ability to deal with whatever happens. This isn't just a trading skill. It's a life philosophy that transforms how you approach uncertainty in every area. The process of growing a small account teaches you to find certainty within uncertainty, to remain calm during chaos, and to maintain long-term vision during short-term volatility. These aren't just trading skills. They are leadership skills, entrepreneurship skills, life skills. When you successfully develop these 4 psychological pillars, you don't just become a better trader. You become a better decision maker in every context that involves risk, uncertainty, and delayed gratification. The compound effect of psychology. Here's what most people miss about compounding. It applies to psychology just as powerfully as it applies to money. Every day you practice patience, you're building psychological capital. Every moment you remain detached during losses, you're strengthening mental resilience. Every time you adapt without ego, you're developing cognitive flexibility. These psychological gains compound exponentially over time. The trader who practices emotional discipline for 6 months isn't just twice as disciplined as the trader who practices for 3 months. They are exponentially more disciplined because psychological patterns reinforce themselves. Brett Steenbarger calls this performance compounding, the idea that small improvements in trading psychology create massive improvements in results over time. A 1% improvement in patience might lead to 3% fewer bad trades, which leads to 5% better overall performance, which compounds into dramatically better annual returns. The $100 laboratory. Your small account is actually a psychological laboratory where you can safely experiment with different mental approaches to trading. You can test how different position sizes affect your emotions. You can practice holding winners longer and cutting losers shorter. You can experiment with different levels of patience and measure the results. All of this experimentation happens with small financial consequences, but massive educational value. The insights you gain from managing $100 psychologically will serve you when managing $100,000. Alexander Elder emphasizes this principle. Good traders are made, not born. The making happens through deliberate practice with small amounts where mistakes are affordable lessons rather than account-destroying catastrophes. The professional mindset shift. The final transformation happens when you stop seeing yourself as someone trying to get rich quickly and start seeing yourself as a business owner building a trading enterprise. This identity shift changes everything about how you approach the market. A business owner thinks in terms of systems, processes, and long-term profitability. They understand that some days will be profitable, others won't, but the overall enterprise generates returns over time through consistent execution of proven methods. Van Tharp's research shows that traders who adopt this professional mindset achieve significantly higher long-term returns than those who maintain a get-rich-quick mentality, regardless of their starting capital size.